The stock market in Korea, like all markets around the world, have been exceptionally volatile in the age of the coronavirus. After the outbreak started and turned quickly into a pandemic, the benchmark kospi plunged through the 2000 level, falling to as low as 1,457.64 in March. The situation has stabilized since, as the kospi recently has been recovering quickly. However, in March, when the market was tumbling at an alarming rate, safeguard mechanisms that have been absent for more than a decade were triggered. The first sidecar in 9 years was activated on March 11, while the circuit breaker, a much tougher break, was turned on for the first time since 9/11, a couple of days later. So what is a sidecar and circuit breaker, and when are they triggered? The first circuit breaker in the world was introduced in the US in 1998 after the Dow Jones Industrial Average crashed on October 19, 1987, losing 508 points or 22.7%. That day became known as Black Monday. Korea first adopted the sidecar, a more relaxed safeguard compared to the circuit breaker, on November 25, 1996. The tech-heavy secondary market, kosdaq, adopted sidecar in March 2001. The Korean authority introduced the sidecar mechanism after the country's first stock market index futures was opened in May 1996. It expanded to the stock market option market a year later. Circuit breaker, which has a far broader scope in restriction, was adopted on December 7, 1998, after dramatic falls during the first financial crisis. The kospi, which has reached a high of 792.29 on June 17, 2017, fell 53.8% for 6 months through December 24th, when the International Monetary Fund swooped in. On October 29, the kospi fell below 500 for the first time in 5 years. So, how do they work? A sidecar suspends future trading for 5 minutes to stop panic. It is triggered when kospi 200 future rise or fall more than 5% and hold that gain or loss for at least 1 minute. For a kosdaq, a sidecar is activated when the kosdaq 150 future rise or fall for more than 6%, or when the kosdaq 150 index fluctuate more than 3%. The sidecar only activates once during a single trading day, and it is not triggered within the 5 minutes of trading and the last 40 minutes. Circuit breaker are similar, but the restrictions are far broader in scope. While a sidecar only suspends trades of future, a circuit breaker suspends all trades of all spot trading and related derivative. 3 circuit breakers are possible: when an index falls 8% compared to the previous day's close, 50%, and 20%. During a level 1 or level 2 circuit breaker, trades can be cancelled, but nothing else. Once the suspension is lifted, stocks are traded at a single price for 10 minutes. A level 3 circuit breaker is also triggered when stock fall 1% after a level 2 circuit breaker is initiated. What is the theory behind these interventions? The goal of the market intervention is to stabilize the stock while protecting investors, keeping in mind that the sidecars can be triggered up and down, while the circuit breaker are only activated to falling markets. The sidecar is adopted to counter the potential dangers of program trading. In program trading, baskets of stocks are bought and sold by computers utilizing algorithm. When markets fall and they sell, that causes more declines, and so on. It's a vicious cycle. In the other direction, the breakers are triggered to prevent a speculative rush. The interventions are believed to calm investors and allow them to collect their thoughts, evaluate market information, and rethink their investment choices during the cooling off period. Over the years, the rules have changed. Sidecars were first activated with 3% move. That was increased to 4% in 1998, and then 5% in May 2011. The daily limit for individual stock price movement was changed in 2011 to 15% from 12%. It was further increased to 30% on June 15, 2015, in hopes of attracting the more aggressive participation of retail investors in the Korean stock market. Do they really work? No consensus exists as to whether they really work, and some academic studies question the effectiveness of the interventions. In particular, they note the magnet effect, whereby price may tend to rush toward the trigger price as investors sell to get out before the halt begins. Those opposing the intervention tools argue that they limit participation and thus affect liquidity. They also say that the complete shutdown of the market only contributes to the market panic, while frightening investors from entering the market. In 1997 and 1998, they did not seem to work. In 2008, during the global crisis, the Sidecar activated every single trading day for a month between September 16 and October 15. Korea is not the only country that used these mechanisms. The United States introduced the circuit breaker in 1998 after the Dow Jones Industrial Average crashed in 1987. Most of the countries in Asia, including Japan, India, and Thailand, have a circuit breaker. Those in India and Thailand were triggered on March 13. China invoked its circuit breaker on the first day of 2015. The European market does not have a market-wide circuit breaker, but it does have circuit breaker for individual stocks.